As we've been tracking the progress of our model investor, a 35-year-old saving for retirement, it's clear that reaching $1 million in their nest egg is within reach. But what if I told you that one misstep could set back years of progress? According to Fidelity Investments' recent report, nearly 20% of workers aged 55 and older have less than $25,000 saved for retirement. That's a staggering statistic considering the average American worker will spend up to 30 years in retirement. Let's put these numbers into perspective. If our model investor, who has been diligently saving since their mid-20s, doesn't make any significant changes to their investment strategy or lifestyle, they're likely to reach $1 million by age 50. However, if market fluctuations or unexpected expenses were to occur, it's not hard to see how they could fall short of this goal. To put it bluntly, the numbers are not in our favor. With inflation on the rise and interest rates at historic lows, it's becoming increasingly challenging for investors to grow their wealth without taking on unnecessary risk. And yet, our model investor has been fortunate enough to ride out these market fluctuations, with a portfolio that's currently sitting at $950,000. So, what will this week's numbers bring? Will they be the catalyst our model investor needs to reach the coveted $1 million mark, or will they exacerbate existing concerns about their retirement readiness? The answer, of course, lies in the latest data and analysis. But one thing is certain, with the stakes so high, every dollar counts. Welcome back to our ongoing series where we track the progress of retirement savers. Last week, I shared with you that John and Mary's combined savings had reached a critical milestone. They're just $200,000 away from breaking the $1 million barrier. Today, we'll be examining the latest numbers to see if this week's contributions will push them over the edge. According to Fidelity Investments' recent report, a significant number of Americans are nearing retirement age with inadequate savings. Specifically, 44% of workers between 55 and 64 have less than $25,000 in their retirement accounts. This is concerning, as these individuals will likely face financial insecurity in their golden years. John and Mary's situation is a perfect example of what can happen when disciplined saving meets the power of compound interest. Since January last year, they've been contributing $5,000 per month to their joint 401k account. Their employer matches this amount dollar for dollar, effectively doubling their savings each month. They've also taken advantage of tax-advantaged options like Roth IRAs and municipal bonds to optimize their returns. Their retirement portfolio currently consists of 60% stocks, 30% bonds, and 10% cash reserves. This diversified mix has allowed them to ride out market fluctuations while maintaining a steady growth trajectory. As we analyze this week's numbers, keep in mind that John and Mary's progress is not solely dependent on their contributions. Market performance will also play a significant role in determining whether they reach the $1 million milestone. Fidelity's report highlights the importance of employer matching for retirement savings. In 2022 alone, American workers left an estimated $36 billion on the table by failing to take advantage of these benefits. John and Mary, however, have been diligent about maximizing their match, which has significantly accelerated their progress towards their goal. According to a recent report by Fidelity Investments, the average retirement savings for individuals nearing retirement has increased significantly over the past decade. While still below the desired target, these numbers do indicate a positive trend. In fact, data from Fidelity shows that the median retirement account balance for workers aged 55 to 64 has risen by approximately $30,000 since 2010. Breaking down this growth, we can see that younger boomers have experienced the most substantial increase in their savings. Those born between 1946 and 1955 now hold a median balance of around $175,000. This represents an impressive $43,000 boost from where they were just 5 years ago. In contrast, older boomers have seen more modest growth. The median balance for those aged 55 to 64 has increased by roughly $12,000 since 2010. However, it's essential to note that these individuals often rely on other sources of income in retirement, such as pensions or Social Security benefits. Looking closer at the numbers, we can identify a few factors contributing to this growth. First, many employers have begun offering more generous matching contributions to their employees' 401k plans. This has led to increased participation rates and higher overall balances. Second, there's been a noticeable shift towards more sustainable investment strategies, such as indexing and dollar-cost averaging. While these developments are encouraging, it's crucial to remember that individual results may vary significantly. Factors like job changes, market fluctuations, and personal financial decisions can all impact retirement savings. To better understand your own progress, let's examine the latest numbers in our portfolio and explore how they're contributing to your overall nest egg. As we take a closer look at the latest numbers, it's essential to consider the bigger picture and how they'll impact your long-term financial goals. According to Fidelity Investments' recent report, Americans are increasingly turning to their retirement accounts as a primary source of income in their post-work years. In fact, nearly 40% of workers expect to rely on Social Security and their personal savings for at least 20 years after retirement. Now, let's examine the specific numbers that have led us to this week's update. Our hypothetical investor has seen an impressive growth rate of 12.7% in just 3 months, thanks to a combination of smart investment strategies and market trends. While we can't guarantee similar results for everyone, it's undeniable that this performance is putting our investor within striking distance of the coveted $1 million milestone. To put this achievement into perspective, consider that a mere 5 years ago, the average retirement savings in the United States stood at around $70,000 per household. Today, that number has more than tripled to over $220,000. Such remarkable growth is largely attributed to sustained market growth and increasing participation rates among workers. However, let's not get too carried away with excitement just yet. The harsh reality remains that many Americans are still woefully unprepared for retirement, with nearly 50% of workers reporting they have no savings or retirement plan in place. This sobering statistic underscores the importance of making informed investment decisions and staying disciplined in our pursuit of long-term financial security. As we continue to monitor our investors' progress, it's essential to stay vigilant and adapt to changing market conditions. With inflation concerns on the horizon, now may be an opportune time to reassess your asset allocation strategy and ensure you're positioned for success in any economic environment. Will this week's numbers finally push our investor over the $1 million mark? The suspense is building. It's time to crunch the numbers and see if this week's update will be the catalyst for reaching that coveted $1 million milestone. As we continue to track your progress, it's essential to remember that every dollar counts, and even small increases can have a significant impact on your long-term savings. According to our previous analysis, you were just shy of reaching the $1 million mark, with approximately $990,000 in your retirement account. However, this week's numbers bring some promising signs. Your investments have performed remarkably well, with a 5% increase in value over the past quarter. One of the primary drivers of this growth is your allocation to the S&P 500 index fund, which has historically been a reliable performer. With a current value of $425,000, this investment has consistently delivered strong returns, making it an essential component of your diversified portfolio. But what's truly fascinating is how these numbers stack up against industry benchmarks. Fidelity Investments' latest report indicates that only 12% of retirement accounts have surpassed the $1 million mark, highlighting the significance of reaching this milestone. And with a growing trend towards more aggressive investing strategies, it's clear that the $1 million benchmark will become increasingly important in the years to come. As we continue to monitor your progress, keep in mind that these numbers are subject to market fluctuations and other external factors. However, the current trajectory suggests that you may be within striking distance of reaching this coveted goal sooner rather than later. The question now is, will this week's update